If your mortgage is up for a renewal and rising rates have you worried, we're going to be discussing in this video some things that you should take into consideration as you move into those negotiations. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, I'd like to ask you a huge favor. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. We cover content like this every single Sunday, so make sure to come back to the channel. Come check it out. Today is all about mortgages, and especially if your mortgage is coming up for renewal, have all of this talk about interest rates moving higher. The Bank of Canada has not been shy to discuss what its plans are to move the bank rate to its neutral or just above neutral range. So 3.5. We don't know what that percentage is going to look like because obviously inflation is their main target and that number just continues to grow. So on the short end of the spectrum, we know that interest rates are going higher, but we don't know what they're going to do in the long run. We also have the fixed versus variable. A lot of people, especially the younger population that had to afford more expensive houses, kind of went towards the variable side because the payments were lower and that's what they could afford. Now with interest rates moving higher, what does that mean for the variable? We'll jump into this article that I found here with the CBC, and what they're saying is to shop around. If one bank is offering 509 and another bank is offering 489, that's a 0.25% difference. So saving every dollar possible is what Ron Butler says here. Very good on Twitter, so go check him out if you don't know him already. And then there's another consideration to take here. Yes, we know that different institutions could have different rates. You could go to TD, Scotia, shop around, etc. But when you're putting these applications in, it could be potentially hurting your credit score. A way to get around this is to work with a mortgage broker who does all that work for you, and they have different relationships with different providers. So go reach out to them and go see what your possible options are. Not everything is done through your bank. You could also check out ratehub.ca. We've covered this website many a times to see what different types of rates are out there. Now, each individual situation is depending on what your financial situation is, but you can get an indication of where these banks sit. Now we'll get into the discussion of whether you should be locking in right now or you should be continuing on your variable rate. We did cover this topic before, and I will link that video above of a fixed versus variable mortgage just to get a difference of each. Fixed is obviously at a higher rate because the bank needs to lock in at a longer term. And we cover how the bank sets the 5-year fixed off of the 5-year Government of Canada bond. I'll link that video above just to give you something to track so that you can see what 5 years are going for, or you can search it up on RateHub yourself. Now, the 5-year fixed is definitely interesting right now because would be locking in, and it would be under the anticipation that the Bank of Canada will not be able to get inflation under control, and they will have to raise the interest rate above that 3% that they're coming out and saying right now. You're basically, predicting or allocating that in the future, the Bank of Canada will have to move higher than what they have stated. And that is definitely in the realm of possibilities. I'm not here saying that it's going to happen. It's not going to happen. I unfortunately cannot predict the future, but you would be fixing or locking in a number on the anticipation that interest rates will continue to move higher. Another benefit is that you know what that payment is, especially when it comes to budgeting. You know what that mortgage rate will be for the next 5 years, whether you pay bi-weekly, monthly, etc. That number stays fixed. Now, talking about the variable side of things, it's normally set at the prime rate or just slightly below prime. But we've seen with the Bank of Canada moving higher, that variable rate will move higher, and so too will your payments. Now, over the long run, we've covered it in previous videos, a variable rate mortgage actually costs you less over an extended period of time. But what should we consider when rates are rising? Because we've been so lucky for so long that interest rates have been, at the bottom 2-3%. These are numbers a lot of people haven't seen. So what should we consider? Now, my biggest suggestion right now is to go into the description below, find this website. It's mortgage calculator on canada.ca, and I need you to go in and plug in the parameters of your specific mortgage. How much time do you have left on your amortization period? What is your payment frequency? Plug in the details that you have now to come up with the calculations that you have today, and then work in the future as to what these payments could be going forward. So what I'm saying here is that know your numbers and know what you could be getting into. So I have some, figurative numbers in here: a $500,000 mortgage at a 3.5% interest rate, 25 years amortization, biweekly payments on a 3-year term. So we can see here that the mortgage payment biweekly will be $11.51. Now, what I want you to do here is to factor in just how high interest rates could go to know how much higher your payments could go. So realistically, what you would be doing is saying, okay, if interest rates hypothetically moved a quarter basis point higher, what does that mean for me? So we're going to take that up to 3.75, and we're going to see that instead of the $11.51 that we were originally paying, our rates went up about $31. So we're at $11.82 now. Now we know on the variable side, we'd be paying off more towards interest and less towards principal. But this definitely would be a lower rate, and you would be able to afford it, especially with these numbers being so high. So what I'm saying here is to make sure you know what your numbers are moving forward. So 3.75 going 4%, 4.25 going all the way up to 5, to see what you could potentially be paying over the long run. So moving this up to 5%, just to see how much of a difference it makes. Remember, it was $11.50 at 3.5%. It's now $13.41. Can you fit this into your budget today? Can you take on this risk? Now, there's a lot of different things to consider, and obviously it depends on your own financial situation. This is obviously my tip and suggestion if you do decide to go towards the variable side, is to know the numbers. We know that, I mentioned it before, it is going, your payments, if they go higher, will go towards the interest more and not the principal. So take that into consideration. But if this is your last means of resorts, know your numbers. But yeah, let me know down below what you think. Are you locking in your mortgage from here on out, or are you going variable? Is there a potential that the Bank of Canada won't be able to raise the rates higher? Obviously, don't have a crystal ball. This is just based on knowing your numbers, knowing your homework, protecting yourself in the long run. Make sure that you're making the best financial situation with the information that you have. Let me know down below what your thoughts are. If you're still here with me, hit that like button. I hope you all have a great week in the markets. Happy trading.